Hello traders and welcome back to the new video of Nova Forex. Are you tired and frustrated of seeing your trade stop loss getting hunted by the market? Then this video is for you. So, in this video we would explain all the concepts of market makers in detail which they use to trap the retail traders, and they earn huge profits through this. And then we would share the easy yet highly effective strategy that you can use to trade like the market makers, which are the central banks and bigger financial institutions. Now before we start the video, make sure that you subscribe to our channel and hit this bell icon to never miss out any of our upcoming videos. Now let us move on into the video. So, we would explain all these market makers concepts in detail through which you can learn to trade like them and can earn huge profits by using them. The first concept is sell-side liquidity. Now before we understand all these concepts, let us learn about liquidity first. So, the liquidity simply means the areas where there is big money. These areas could be support and resistance, trend lines and equal highs or equal lows. Let us learn the liquidity concept with an example. So, here we have the Euro-Canadian dollar chart on 1 hour time frame. We can see that the market is making higher highs and higher lows, which indicate that the market is in an uptrend. And then we can see market going into the consolidation phase. We can see market creating a support level here as the price went upwards after reaching at this level 2 times before. And thus, a lot of retail traders and small institutions would set their buy limit orders at this support zone in order to make up a profitable trade. Now here is where they get trapped, as the big players have set this support zone trap for the retail traders. The big players would manipulate the market and bring the price below the support zone in order to hunt the stop loss of the retail traders and the small institutions. We can see market doing the stop loss hunt by this candle with big lower wick. And here also some of the traders would initiate short position. And after that we can see market making big green imbalance candles, which indicates that the central banks and institutions have entered into the market. The big players of the market sets a trap like this as they want to enter the market with a huge capital. And also, they would not initiate all their orders at one point, because if they do so then the price would shoot up, which is why they would make less profit. And so, they bring the price again to this point in order to fulfill their half remaining orders into the market. Here also they again set a trap for the retail investors and the smaller institutions in order to make good profits into the market. Now that we have learned the liquidity concept, let us learn about the sell-side liquidity. So, the sell-side liquidity is below the support zone. The central banks and financial institutions initiate their buy trade into the market when the price do not respect the support zone and moves to downside for some time. Now a question might arise into your mind that why the big players of the market are hunting the stop loss of the retail traders and small institutions. The reason behind this is that they do this because if they want to initiate buy position into their market, then they will need sellers who can sell the currency pair to them, and which is why they set a trap like this, as they know that most of the retail traders and small institutions use support and resistance levels and trendline for initiating their trades into the market. And with a small body candle with big wick to the downside can hunt the stop loss of the traders who use the support and resistance levels and trendline for taking buy or sell positions into the market. And thus, I recommend you to wait for the market to make an opposite side big candle with small wicks, which is green candle in this support level case, as it confirms that the market is respecting the support level. And you must remember this thing, that most of the traps that are set into the market is at that time where the market is coming to support zone or trend line for the third time. Now let us see the second concept, which is buy-side liquidity. So, the buy-side liquidity is above the resistance level and above the trend line. When the market has respected the resistance zone 2 times previously, then a lot of retail traders would set their sell limit order at this resistance zone. Now the big players of the market is knowing about these limit orders, and if they want to initiate their sell trade into the market, then they need the buyers who could buy the currency pair from them. And this is why they create a fakeout. Let us understand this concept of fakeout with an example. So, here we see price respecting this zone 2 times, and thus, a lot of traders would sell the currency pair once the price reaches back to this resistance zone. And in order to earn big profits from the market, the smart money would manipulate the price and bring the price above this resistance zone, which is why a lot of traders would be stepped out of the market as their stop loss would have been hunted by the market. And once they are removed from the market, the smart money would be able to initiate their sell trades into the market, as now the number of buyers have been increased into the market. Same happens with the trend line. So, as you can see here that the market is making lower highs and lower lows, which indicates that the market is in a downtrend. We can see that the market respecting this trend line for 2 times. Now a lot of retail traders and small institutions would initiate their short position once the price reaches at this trend line for the 3rd time. Let us see what happens if they initiate their short position at this point. So, as you can see here that the market did not respect this trend line and moved above the trend line. Now a lot of traders would initiate their buy position at this point, thinking that the market has switched its direction from bearish to bullish due to this internal change of character that the market created. Now let us see what happens if we would have initiated our buy position at this point. So, as you can see here that the market went downwards, which hunted the stop loss of the retail traders as well as the small institutions. Now let us learn the highly effective strategy that you can use in order to make up a profitable trade into the market. In this strategy we would use the order blocks, fair value gaps, as well as the buy side liquidity and sell side liquidity. Let us learn this strategy with an example so that you can understand it properly. So, here we have the Euro-Canadian dollar chart on 1 hour time frame. We can see that the market is doing the break of structure to the upside, which indicates that the market is in an uptrend, and thus, we would find the support zones in order to initiate our buy position into the market. So, here we can see market making a sharp move to the upside after coming to this zone, and thus, we can say that this is a support zone. And now that the market has respected this zone for 2 times, the retail traders and small institutions would set their buy limit order at this support zone. Now let us see their result of the trade. So, as you can see here that the market did not respect the support zone this time, as the price went below the support zone. And now the retail traders and small institutions who have not initiated their trades here would initiate it at this point in the short position, as they think that the market has switched its character from bullish to bearish. Now let us see the result of the traders who initiated their trades at this point. So, as you can see that the market hunted the stop loss of these traders also as the price went upwards after coming to this zone. Now let us see the same chart on 4 hour time frame. So, as you can see here that the market created an order block zone here, which the market respected, and those traders who used only the 1 hour time frame got trapped as their stop losses were hunted into the market. Now let us see one more example of this strategy in order to make sure that you understood it properly. So, here we have the New Zealand USD chart on 1 hour time frame. We can see that the market is doing the break of structure to the downside, which indicates that the market is in a downtrend, and thus, we would find zones at which we can initiate our short position into the market. So, here we can see that the market has created a resistance zone here as the price made a sharp move to the downside after reaching at this zone for 2 times. And thus, a lot of retail and small institution traders would set their sell limit order at this zone. Now let us see what happens to their trade. So, as we can see that the market went above the resistance zone, which hunted their stop loss. Now let us see this chart on 4 hour time frame. So, as we can see here that the market wanted to reach at this higher time frame supply zone, which is why it swept the liquidity of equal highs to upside. And here also, The retail and small institutional traders who used only one time frame got trapped. And which is why we recommend you to read and analyze the charts of the market on lower time frame as well as on the higher time frame. This brings us to the end of this video. So, in this video we shared the highly effective trading strategy that you can use in order to make huge profits into the market. Now before we end this video, be sure to subscribe our channel and hit this bell icon to never miss out any of our upcoming videos.